Let's get some more perspective from an investor on some of the big tech earnings that have crossed. We want to bring in now Ross Gerber. He is co-founder and president and CEO of Gerber Kawasaki. Ross, always a pleasure to speak with you. I know that you look at Tesla very carefully, and the results are out. And I know that the stock has moved independent of what the company has told us about the sales of its EVs. But I do want to get your take on the gross margin number that came in for the fourth quarter. Automotive gross margin, when you back out the regulatory credit, was 13.6%. Is this enough to move the stock for those who are fundamentally focused on Tesla?
Well, I think this is actually a bad number, right? I mean, gross margins continue to decline even after all the layoffs and stuff last quarter where they got the benefit of higher margins because of that. Now margins are continuing to decline because they're having trouble selling cars for obvious reasons. And so, it's really a game for Tesla of like, they can manufacture actually a lot more cars than they're selling, so they just hold back. And then they have to do pretty much every demand lever possible to get rid of the vehicles. And so we're seeing it in the numbers. And once again, I'm not surprised by it. Mm-hmm. They don't advertise, and the only advertising they have is Elon.
Right. Well, he's a pretty effective advertiser, we got to say. Ross,
not for cars.
Not for cars,
truck.
For other things. Yes. Well, I mean, at some point, does the tide turn on Elon Musk and the gains that we've seen in the stock, up 55% since the election, up 83% since the last earnings, start to drive down the stock in a way that's, again, divorced from fundamentals of the vehicle business?
Well, once again, the stock is actually down over the last 3 years. So when you look at it from 3 years ago, we haven't made any money in Tesla. And at that point, they were expected to do $4 in earnings, and it traded at 100 times earnings in 2021. So we were at $400 a share. Today, we're at $376 a share with $2.46 in earnings. So when you actually look at Tesla's financial performance over the last 3 years, it's been horrible. And so this is a growth company at a huge multiple that isn't growing. So what's going to get it to grow? That's the big question.
Well, I am curious, just beyond just building cars. I mean, there was this whole narrative, or at least really a whole model into the thesis, the bull market thesis of Tesla, that it was more than just a car company, that some of the technology components, AI, autonomous driving, blah, 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 all this sort of is what gave it such a higher valuation relative to a GM or Ford. It was a tech company. Is it still a tech company? And if so, when can we see them actually leverage some of that into real growth?
I mean, there's no question that it's a tech company in the sense of its focus really is on software and developing software for robots and autonomous vehicles. But their core business is selling cars and energy storage and charging. And that's what Tesla was founded. His mission is to advance sustainable transportation and energy, and that they were doing a wonderful job before they pivoted into a bunch of businesses that we're not sure how they're going to be, which is robotics and cybercabs. So, and that's not coming anytime soon either. So I just come kind of like asking the question of like, where does the growth come from over the next several years until these technologies work? I use full self-driving every day, and now I see Waymos every day all around me driving perfectly fine, and my car still can't do it. So I don't care how many times Elon says that it's going to work this year, and this is the year of full self-driving. It's just a bunch of crap at this point. It doesn't work. It still doesn't work. So it works pretty good. I like it. But it's driver assist. That's where we're at still.
Hi guys, welcome back to my channel, The Wealthy Mindset. It's yours truly, Money Making Mitch. And as usual guys, this is not financial advice. Please do your own due diligence and research. I think you guys will find this is the conclusion to the GM video I did yesterday. And for my subscribers and true investors, you will really enjoy the conclusion. So before I continue with this video, all I ask is for you guys to hit that thumbs up right there, right there. Thank you. Because it takes a lot of time to do these videos and the editing. And also, it will not just help bring awareness to the channel, but to NEO as a whole. And as usual, I will post the link to that Facebook group that our own subscribers are here and I started, that we're keeping it a pure Neo bull group. So let's continue with this video that I think you guys will find very yummy to the tummy. As China's economy matures, its consumers are finding that the foreign premium in quality is going away, or at least it isn't worth as much anymore. It was kind of ridiculous for a while that the foreign brands owned 70% of the Chinese market, says Philippe Hochos, an analyst at Jefferies. But Bill Russo, who used to lead Chrysler's effort in China, thinks Chinese car makers have realized something about cars in the 2020s. They're basically phone on wheels, computer on wheels. Chinese consumers expect the EV to be a smart device. The Chinese companies have that idea, they're demonstrating it, and they're dominating it. Like NIO, we're dominating the landscape now. Because we've taken the premium segment, we've dominated the premium segment, and now we're getting ready to dominate the sub-brand segment in China this year. You heard that right. Watch when the ramp up with Onvo comes. Watch when we release Firefly and that ramp up comes. And that big 7-seater and that big 5-seater we're releasing also this year. Western officials and CEOs, however, blame something else. China's use of subsidies, they say, and overcapacity. They're making too many of them. Over the past few years, a host of officials in the US and Europe have complained that Beijing is using subsidies to promote manufacturing, which in turn leads to more production than China's consumers can reasonably ingest. So they should only make enough for the Chinese consumers, the Europe and America is saying. Domestically, that leads to price wars and disappearing margins as companies struggle to survive. As we see with Tesla, it is true for them because they stop innovating. Internationally, it leads to below market price exports undercutting local manufacturers. How dare they come and give an affordable EV with a superior technology within? How dare they do that, they're saying. I'm a free trader. Give me a level playing ground and let's compete based on our product and how well we serve the customer, Barra said in her October Fortune interview without commenting specifically on Beijing policies. So she wants the playing field to be level, Barra said. It is not level in her opinion. Well, let's see. The subsidy narrative is half accurate, says Christopher Bador, Deputy China Research Director at Givical, a financial research firm. The Chinese EV market would not be where it is today, would not be as competitive if it wasn't for those original subsidies. You can't go back in time and remove those subsidies, but complaining about subsidies now is missing the point. Chinese car market has moved towards EVs and companies need to adapt. The argument is that Beijing attempted a classic infant industry approach and now you're mad at them because it worked, Bador says. Is it a race to the bottom in terms of pricing? Yes, that's what you expect in a competitive market, unlike here in America, Canada, and Europe, where there's no competition and they force the consumer to pay exorbitant prices that is extremely ridiculous that the consumer cannot afford. Sao points to Tesla as the example that undermines the argument that the subsidies benefit only Chinese companies. Beijing helps Tesla through subsidies. Yes, you heard that right. Both on the production and the consumption sides. If you make the commitment, Beijing is happy to give you subsidies as well, he says. So if they see innovation, if they see, they don't wait for you to fail. If they see that this is a product that's going to be in demand, they help you. Just like with NIO, with the battery swapping, they see it's the way forward in the future. GM's very public struggle in the world's largest car market aren't for now threatening its global business. GM posted $140 billion in revenue for the first 3 quarters of 2024, an 8% year-on-year jump. Profits are up too, jumping more than 10% in the same period. GM is doing especially well in the US. Of course it is. Its home market, ending the year in the first place in overall sales, where there's no competition. On January 20th, GM reported full-year revenue of $187 billion, a 91% jump. Investors too are unfazed by GM China's struggle. Share buybacks and surprisingly resilient earnings helped push the carmaker shares up 50% in 2024 as the broader S&P rose by just half that much. A weakening China business does not directly hurt GM prospect for success in the US. Whiston says. He also notes that the China joint venture, not GM, is paying the $5 billion restructuring charge. And GM is sticking to its ambitions by US standards EV strategy. The company still hopes to get rid of traditional cars by 2035 and expects to make money on the battery-powered EV by the end of the year. But now with Trump saying that they're going to take away EV subsidies, etc., it gives less incentives for these American companies to do this and to continue. And they will stick to most likely their gas guzzlers, and China will move forward and move ahead and dominate the world landscape where the global South, ASEAN and BRICS are embracing electric vehicles. So for now, GM is promising to stay in China. GM is working closer than ever with our joint venture partner SAIC to restore the business in China to make it profitable and sustainable, the automaker said in mid-December statement. We think it's a market after we restructure, we can still participate in an appropriate way, and it can be a business that has growth for General Motors, Barra said in October. So since they have a joint venture with SAIC, one of the companies that has teamed up with NIO for doing battery swapping, it is only logical to say that they will have to adopt battery swapping as well. This is why NIO is the only way forward. I hope you guys found this video, the conclusion, to be informational, inspirational, and motivational yet again. If so, guys, do not forget to hit that thumbs up because it takes a lot of time to do these videos and the editing. And if you haven't yet subscribed, you might want to think about doing so because in this channel, we are waking up the middle class for the first time to get a major piece of the pie from the ground level up as to how the game is played in Wall Street. And like 50 said, we get rich or we die trying, guys.